So this is the S&P 500, and as we can see, this week has been a bit shocking. We've actually had two gaps down. This is the daily chart. If I move it to hourly, even in the last few hours, it has not been good, and we're not sure that it's actually sort of finished yet. It might go further down yet. We just don't know. I'm not going to try and predict it, but if I go to the longer term, you can see back here in the middle of the screen, that was the pandemic basically, and even after the sort of pandemic at that level, you know, we're getting to the sort of point where it was after the pandemic. So it's certainly been worse in recent years, and the main thing is, somebody to admit, the main thing is that we had our protections in place to make sure that that drop, which was a fair old percentage, let's have a look, from there to there, that drop was 22%. So the market fell 22%, or the index fell 22%. And because we look after our buying power and cash, then it didn't have the effect of killing us. We're not sort of we're not in a mess because of that. And at the other end of it, we're in Opportunityville because there are some fantastic bargains out there at present, because they're very fundamentally strong companies that are vastly undervalued, even well under their book value. Unfortunately, as our stock buying power goes down, as the value of the account goes down with these movements, then our ability to jump on some of them moves. But we have been jumping on some of them, and even today we might have another one that I think we'll just have a quick go at. So that
because we get higher premiums when the volatility is not quite off the charts, but certainly quite high at the moment, you wouldn't advocate waiting until things settle down before jumping onto trades?
Not the one I have in mind, at least. No. Here is the VIX, which has jumped up. So the volatility is it is high. It peaks at about 38, and it's currently about 33. So what happens is, as the volatility increases, the premiums that we get for selling puts increases, but the volatility is reflecting lower prices. So if you've got plenty of buying power, that's great. You simply sell a put and get more premium for it, and you're selling it at a lower strike price that you can well expect to be exceeded within a reasonable period. But what I'm mainly doing is trying to look after the trades that we've already got, and in those circumstances, and we'll go to the spreadsheet and have a look at some. Where are we? There we go. This is fairly up to date, so you should be able to see a spreadsheet.
Yeah.
So this is T's, and where my eye goes to is this right hand column here. So we've got AEO, which as a retail stock is one of the main ones that's suffering at the moment. So we sold a put at 22, a strike price of 22, and then we sold another one as it came down to 20, but it's well below that now. It's now at 11. But it's still only 55 cents out of kilter because of the decent premiums that we got. So the choice is open new trades or look after these ones, and I'm more inclined to look after the ones we've already got when there is buying power available to do it. At the moment, well, last time I updated this, which would be yesterday, that we're in the negative on buying power, quite significantly. We'll see how much when I go to the trading account. So those types of trades, there's what I'm actually doing is taking the calculations on which are the best trades to do, irrespective of what we've already got, and saying, are any of those trades in our current list? So, for example, AEO might be one. I'm not sure there's one on there. I better have a little check. AEO, no, but sorry, need to stop sharing, start sharing again. But lost me spreadsheet. There it is. Yeah, so for example, these are just the figures I did at the beginning of this week, and there will have been some big changes because we've had some big price changes, but certainly it won't have changed that much. And Bed Bath and Beyond were basically top of the hit parade, in that the price is very, very low at $6.46. The forecast is that we'll go up to about $26. That's from Owen and Co. Value lines say, yeah, they think it could get up to a high of 20. Their mid estimate on the 18 months is 12. And in the longer term, they see it as being at a midpoint of 27.50. So ranking them as I do, short term using Owen's forecast, medium term and long term using Value Line, I find that they ranked first, 15th and 5th. And what I'm interested in are the top 50. So Bed Bath and Beyond are well within what we would want anyway. And then if we look, and you should have changed back to a different spreadsheet now. If we then say, right, okay, Bed Bath and Beyond, we've already got some puts on it. We've got a January 23 $30 strike price and an August 30 strike price, so way out, and it needs some help. But as it needs help and it's on the top of the list of the sort of most wanted for this week, irrespective of who you talk to about it, then that is one where I would target help. We could easily dilute that down to a lower figure, and in fact that's what I want to do. But the stock buying power is low, and I don't want therefore to use a tremendous amount of it. Our overall exposure isn't big on it. We've only got sort of 400 shares. So on this occasion, what I'm looking at doing with that one is actually just buying some shares and selling a call, because the call option premiums are very good at the moment. So rather than say, okay, we'll sell the put, wait for it to get to 8, 7 or 8 or something, and use that as an income generator, there is some nice premiums to be had without using as much buying power when we haven't really got that much to spare to do it in a different way. Does that make sense?
Yeah.
Yeah. So for example, calculator out.
Jeff, can I just ask a quick question?
Yeah, of course. Yeah.
So I guess the only way to increase your buying power right now, our buying power, would be to, in some way, kind of get out of trades, which we don't want to because we're sitting underwater with them. So would that be correct with the way the market's moving at the minute?
That is correct. But there are several ways of increasing buying power. So, for example, we can, where we have, if we've got any stocks that are in the black, there's one, CNDT. So CNDT we paid an average of 781. They're down at 434. We've got 1,600 of them, but because we got 495 in premiums, that could be including some calls, I'm not sure. We're actually $1.48 up. So if we wanted to take that profit, we could, and that would immediately increase our buying power. It would give us at least sort of 7,000 or something worth of it. However, that's a stock.
I'm not advocating any shape or form of policy at all. I'm just trying to get my head around it in these uncertain times.
Yeah. Well, one way of doing it is to sell things that are out there already. So where we can take a profit. There's been a good rise on EDU now. That's actually wow, that's up at $21, and there's a bit of jiggery poker on it. That if you remember, it's a 10-for-1 split, but we're actually $20 up now. We're now $20 up on that disaster. So who'd have thought?
Yeah.
And others, there are others as well where we could do it. But to be honest, I mean, if you take that CDNT example, it would be very, very easy for that stock price to double from $4 to $8. So we're unlikely to do something more profitable with it. Another way of increasing the stock buying power is to buy some lids. So what would happen there is, if I try and find an example, let's have a look. Yeah, it could potentially work with a ATIS. No, find a bigger one than that. There's a bigger one. Yeah, so with big October put, so we've got an October $30 put. Sorry, it's not a big enough difference between us there. And try and find a better example. I want one where there's a big difference. There's one, CTRN. So CTRN, we sold a put with a $40 strike price, and it's currently down at, call it 24. If we were to put perhaps a $30 lid on it, actually buy the lid, then we would be reducing our exposure on it by $30 per share. And in so doing, we would increase our buying power. So if we really need buying power, we could do that. What that would mean is we'd have to watch it, and come August before expiration, then we'd be saying, right, okay, we did that as a temporary measure to increase buying power. We do expect the market will have moved up a bit, at least since before August. We would then have to remember to sell it again, hopefully at a profit. So we can get a temporary increase in buying power if we want to do it that way. So that's there if we need it. I've had two members whose private accounts have gone into the negative, and they've been asked to put some money in their account. So we used that technique on both of them to get them out of having to put money in their account. We increased their buying power so that the margin call was cancelled. So yeah, it does work. I've actually used it with people today, people who didn't guard their buying power quite as well as we have. Not that I'm criticizing them, it was easily done. Yeah.
One question: what would be the effect on buying power if we were to buy calls on shares that we didn't yet own? So instead of, you were talking about buying Bed Bath & Beyond shares and selling the calls, but instead of buying the shares in anticipation of them rising, you bought the call in anticipation of them rising, would that have a positive or a negative effect on the
it's something power? It's something we don't do, Andy. We don't like to buy things that expire worthless. But I'd have to actually test it, but I don't think it would have an effect either way. So if we bought a call, we'd be buying the right to buy, to take shares, to call shares for somebody else. And what that would mean, but we haven't actually bought anything, so we haven't actually gained an asset. We've gained a right to buy something. So I don't think it would affect the buying power either way, except the cost of the purchase would come off the buying power. Okay. Now, some stocks, when you own the share, you get more buying power. So if we put $1 into the account as cash, it immediately gets doubled as far as buying power is concerned. So if we stick $1 in, we get $2. Some stocks are considered such good, fundamentally sound companies that if we buy $1 worth, we would get $3 of buying power, or even $4 of buying power. So another way of increasing the buying power is to actually buy some stocks. Crazy as it might sound, you buy stocks, you get more buying power. I'm not sure if that is the case with Bed Bath & Beyond, but I will show you how we find out. So I'm going to stop sharing this and start sharing something else. I'm such a sharing, caring person. It should be on here. Oh, I need to go there and not quite open it. There we go. Right now I can share it. There it is. Okay, so this is our back office. And if we scroll down, we come to the margin balance details. Go into there. Scroll down again, and we've got these columns. So one of the columns here is headed maintenance requirement, and that's basically the stock buying power that each of the trades is holding. So if we click on it once, it ranks them, but it ranks them the wrong way around. So we click on it twice, and there we have it. So we can actually see that the stock that we've got in RCII, the Render Center, is the one that's holding the biggest amount of maintenance, the biggest amount of buying power. Then it comes down to Sleep Number, then Sage, then Big Lots, and then Bed, Bathroom & Beyond. So Bed, Bathroom & Beyond is up there. And we've got we're not overexposed on it. So that is the one. I think if we buy some of those shares, we will get extra buying power and the opportunity to make probably about 13%, at least, could be 25% between now and July on that purchase. So that's the one that I'm interested in doing. Shall we have a look and see how that goes? So we go back to the, it's like the olden days, buying shares and selling calls. That's what my grandson refers to, as in Grandad, what was it like in the olden days?
It was very different.
Yeah, I know, but his olden days are not the same as
No.
Just opening the trading clock. Right, okay. So back to share. There we go. We're on the right one. That always helps. Yeah, and so even since yesterday, that fall has taken the net liquid value down. We've got no shortage of cash, and we have got $33,000 worth of stock buying power. So we're not exactly short of stock buying power, but had we not maintained it at the 50% level or so, we definitely would be in trouble with it. But I do think we can.
I think that just goes to show, Jeff, how important it is to be disciplined like that, doesn't it? When things.
Oh yeah, absolutely. There's no question about that. Yeah, the only people I know that we've had to take sort of action on are people where they weren't disciplined in that respect. So that's where they're at. But we still were able to get them out of it. No problem whatsoever. They're safe enough. So we don't want to spend a great deal, but we don't have to spend a great deal on bed, bathroom, and beyond. At let's have a look. $3,000 divide about 6.5. It was, wasn't it? Yeah. I'm suggesting that we do spend a couple of bob on some bed, bathroom, and beyond stock. One, to dilute these 30s that we've already got, given the current stock price is $6 odd, and two, just as a way of making a quick buck between now and the July expiration date. And here we have it. So we've got, I think it was 400. So we can halve our exposure by, or not quite halve it, we can vastly reduce it by bringing it down and make some money. Are we all right with this?
Yeah.
So was our BBY
Yes.
Sounds all right, Jeff. Yeah,
positions
absolutely.
not 2 lots of 300?
This no. What was it?
One in January, one in August.
You're all in. You're all
Yeah,
in.
I thought it was as well, Jeff.
You're all
Andy's right.
way down. I can't get to my spreadsheet. Let's have a little look. BBBY. Yeah, you're right. It's 600. So I think we can go to 600 if we needed to sell some. We could actually get them back. The other thing we've been doing with some people is a lot of the calls that have been sold already are now in such a state you can buy them back cheaper and actually make a profit on them. That then clears the stock to do something else with, which is to sell it and then to sell a new put, and that also increases buying power. So if we need to do that, we could. So we're buying. Need to press the wrong button. There we go. And it's actually been going up. It's now 652. I'll go for it anyway. I'll go for it anyway. We can use the up and down button on it. So we're going here now. We're not going to give us a 648. So because it's single cents, we can use the up and down buttons. So we'll go at 1 cent at a time and see what we get. Oh, we expected to get it there. Come on, guys. There we are. 652, and we've got 600 of them. So we've got two things we can do with that. As far as the option chain goes, at least, we can just say, well, what's available now? Or we can say, no, let it rise a little bit. Leave it a week or so and do it then. So we'll consider both options. So we're on this side of the screen. The price is still 650, 660, so below 7. So we could actually get 85 cents at present. That's without negotiating. So 0.85 divide 6.51 we got. That's 13% plus another 50 cents or so if we called out. And on the 8, it actually goes down. On the 8, it's going down, obviously. So that's one action. The second action is to say, no, hang on, let it lift a bit, and then we'll do it. Of course, as we let it lift a bit, then the volatility will also move. That'll probably come down. So then the premiums would come down with it. So any thoughts? Would you like to have a little look at the chart? That would be an idea. There it is. So it is at a very low, not much further we can go. I would, if we'd been selling a put, I wouldn't have even put a lid on it because it hasn't got any much further can go really. So do we take some money off the table now, or do we let it rise probably up to 7, which it ain't got far to go, and then sell it?
Jeff, I think one question I'd like to ask, and what your opinion is, because of the macroeconomic situation and and all the stuff that's going on with the Fed and wanting to raise 3/4 of a basis point potential to counteract inflation and stuff like this, do you believe that? Do you think that in some respects that we are in a bit uncharted territory when it comes to following the charts in a way that they would do normally, and because we're in such choppy waters for a few months potentially, do you feel that you need to, I don't know, take different action than you would do normally?
Well, one, not much is new in this world, so we're certainly in areas that we have been in previously, and I can see what's happening. So when we get uncertainty, the market doesn't like it, and it goes down. Plus, it also doesn't like bad economic news, like unemployment and economic sort of figures on the economy forecast and so on. It got a shock basically with the pandemic, and by now it would normally have bounced back. That was then followed by another shock with, are we going to war, or at least more uncertainty, are we going to war or not going to war in the Ukraine? And eventually it did. By now it would normally have overcome that shock, but now we're getting aftershocks, most of which don't directly affect the States. So they're not bothered about grain, for example, directly. They're not bothered about energy directly from Ukraine. What's affecting them are the secondary effects of, for example, energy prices. With the shortage of supply from Russia, then the price is going up. And of course, the Americans don't just sit on their hands. They say, no, the world prices have gone up, we'll put ours up. But yeah, they will find that demand is falling. I don't know about anybody else, but I'm noticing fewer cars on the road at the moment. So we have no doubt that it will begin to rise. And the stocks that are most affected at the moment are stocks like this, retail stocks. It's when I went through Sunday night's forecasts from Owen, the list I ended up with as being, if you like, the best buys were riddled with retail stocks because they're the ones that have been hit so hard. And we think they will recover, but we also think they'll take quite a long time. So we're looking at sort of Januaries and beyond on them. So I wouldn't say we should not bother with the charts.
No, that's the last thing I was saying. I'm just interested to have the debate, as to where we are at the minute, because it is quite, certainly for the time that I've been involved, and the people, probably most of the people on the call tonight have been involved. Yeah, this is
It is, but this is also a fairly regular event. It is sort of every 2 or 3 years we get one of these. Let's have a look at the S&P 500 again. Further, there we go. So I'll go to weekly just so we get more of a look at it. And if we go over time, we regularly, that was a much bigger one. The pandemic, we had one there. That's 2019. you got to sort of come out of it probably just to see some of them.
Jeff, can you just put it back to 06, where the last financial crisis kicked in 7 and 8? There we go.
Yeah.
So in proportion to, yeah.
Yeah, I mean, it's not quite as bad, yes, but it did begin to recover, and although the recovery took a while, that's the S&P 500. So some of a lot of the stocks in there had been vastly overpriced, as some of them have been now, and therefore came down with a thump and took a long time to recover. At the same time, the ones with the lower price to earnings ratios, which are the ones that we tend to be in, recovered more quickly. And that's exactly what we expect to happen again.
Sure. Yeah. So I think it's very interesting to look at it from a longevity point of view.
Yeah, yeah. But yeah, it was actually long predicted, and it came. That's what's happened. Okay, so back to the decision in hand. Do we want to take some money on this now, or leave it? You know,
given what you've just said about the uncertainty, and that a rise in any stock is by no means a given, even a very small rise in Bed Bath and Beyond from 6.45 up to 7, is it not better, given the fact that we can get a decent premium for it, to at least try and get something?
I think so.
Yeah,
I think that we should take the premium off it, and then do it again in July, and just keep doing it. Just keep taking money off it.
For my opinion, I'm all for going to take advantage of situations that we find ourselves in. I just think it's important just to put it through there, just to discuss it. So we
absolutely. No, that's, if we got called out on it, it would be 7 minus, it was 6.5, it was thereabouts, plus 0.85. That'd be $1.35 divided by the 7, which is, that's 19% between now and July. To me, that's and we get the benefit of it diluting the Bed Bath and Beyond positions that we've already got. So
cool.
That's the way to go.
Yeah,
We're headed there. You should be able to see the trading platform again now. So we're in July. I'm only going as far as 7. It's improved slightly. It's 88 cents now. We've got 6 contracts we can do with it. There's a bit of a spread. It's in single cents, so we might as well go for the 92. Verify it to see, and it's even better there. It's up to $1. So we'll actually go up to the $1. We can very quickly change it on using the arrows. Bring it down 1 cent at a time until we find it. There we go.
Oh, brilliant. Well done. 98
cents. So that's mad, isn't it?
That's brilliant.
0.98 divide 7%. So we got 14%, even if it's not called out, and we basically bought them for call it $6.50, and we're now exposed at $5.50. So we've even got $1 cushion on it. So if we go across to the stock buying power, we have used a bit. We've used a couple of thousand on it, but hey, as long as we sell it for more than $5.50, we'd be back in. Okay, so there's not a lot to do. We're basically sat in a hole waiting for the thing to turn around a bit, and when we've got what's called a falling knife at the moment. You don't try and catch a falling knife. We've got to see where it lands and then pick it up. That's where we're at. I thought I had something to show you, but I think I've deleted it. I'll talk you through it anyway. This this is my holiday. Sorry, I should say this is my last holiday. I'm going again on Tuesday. So I'm sat. I'm sat. Well, I wasn't sat. I don't sit.
Cruise again, Jeff? Cruise again?
No, beach holiday with grandchildren and stuff in Port-au-Prince, New York. I like it there, mate. Yeah, so I was thinking last time about what are we actually doing in terms when we're investing here, and trying to squeeze the more out of the trades. So up to now, I've generally concentrated on trying to squeeze more out of it by finding the best trades, the ones that have got the biggest potential to go up, and the forecasts are all saying going up and so on. But we also want to squeeze as much as we can out of the stock buying power. So the stock buying power is our capital, and so that's just my central data source. That's the one I update every week. So I change the forecast each week, and I go through all of the value line reports, because unfortunately I found that they don't only change their forecasts when they produce a new report. They change their forecast when they change their forecasts. So now I go through all of them every week and update their forecasts. And the next stage after that, have I done it on this one? No, I haven't. The next stage after that is to rank them. So I now sort of say, right, okay, then rank all of those in terms of the forecast percentage increase that we're giving them. I then get rid of any that are not in the top 60 or so I take for what Owen's forecast. I then rank them again on the medium-term value line one and knock out anything that's not basically within 60. I've left something in there because it's two of the scores were very good, and then I do it again for the long-term one, and then I rank them after that in terms of their potential increases. I then normally go a lot further than that and start comparing the premiums that are available and the effect on the premiums of buying the lids and so on. And what I thought was, when we do that, we use an amount of stock buying power. I didn't do it all this week because I didn't need to. We didn't need any. Here's one. So this was from the 24th of April. So I've got the percentage increase, and even you notice GPS, retail. Spotify is really not retail, but not quite. We've got big in there, RCII, a lot of retail stuff in there, far too many that we would want. So I take the increase, and then I say, well, okay, if I was doing it, what strike price would I want? Where would the lid be? What's the premium? And I go through them one at a time and get those premiums. And then what would we want to pay for the lid? What's the net after that? What's the return on investment? Then I look at how much stock buying power it uses. And then we get a return on that stock buying power. So again, I make sure that the return on investment is reasonable. And I rank them on that. I rank them on the return on investment too. I say, well, if we close it early to avoid paying for the lid, what do we get? And I then started to take into account the number of days it's going to run, how much premium do we get per day, and some of those were down. Look, you've got a difference between sort of 19 at the one level and sort of 5 cents. And some of them are sort of 2 and 3, so kill them off as well. But what I'm also starting to do is to say, well, okay, then that's fine. Yes, we want a minimum amount of gain per day on it. But I also now want to divide the gain per day by the amount of stock buying power that it's using. So if it uses a lot of stock buying power, then I want more gain per day to cover it. So if it's too hefty a user of stock buying power, it will also get knocked on the head. So that's where I'm going to next with it. I've also started looking more closely at, you can see in the final column, I've got the price to earnings ratio. And we want low ones, and so there's the odd one in there that I think, whoa, what's going on here? And it's Spotify. So Spotify have got a high price to earnings ratio, but they've got also very good forecasts by Owen and Value Line, so short, medium, and long term. So the question is, do we forgive it for having such a high price to earnings ratio? Another one like that, and that line is there because I've stopped counting them after that. I put that in, so no, these above the line, they made the cut. Below the line, they didn't make the cut. But the next one that was horrendous was eBay. eBay didn't score so well on the forecasts, so I didn't have to worry about it anyway. So by the time I've done all this, Owen sort of starts off with 160 stocks. He normally recommends 50 or 60. I usually bring that down to about this number, about a dozen or so. But I want the absolute best of the best from them, and I want them to meet all of the requirements. So that's where I'm going to next. I'm now turning to wanting the best return we can get on stock buying power. That was
Sorry,
yeah.
just a question here on your PE. Is that the PE from Value Line?
It's the PE. So how I get it is, you know that you put the stock in here and you use on data, you use the stock thing, and then it gives you the current price,
Right.
etc., etc., etc. So it comes from that. So
Okay.
so actually from Bing. That's where I get it from.
Okay.
Do you believe it?
No,
Okay.
no, I don't.
I mean, for instance,
I don't believe it as such. I mean, it's a moving feast anyway. As the share price goes up and down, the price to earnings ratio goes up and down. I'm only using it as a yardstick. If it's 200,
Jeff, what's your viewpoint? I mean, you may have just mentioned it, but just to clarify it, the Spotify PE stands on like a sore thumb.
yeah.
So would that take you away from that stock in that respect? Or would you just kind of, because we all know that tech stocks are being absolutely mullered because of the risk off stuff at the minute. So
it would certainly make me more careful with it, and I wouldn't want many of them.
Sure.
So I mean, and if I go back to my main data sheet there, and I'll find out what line it's on, that'd be a good idea. They're not always in order because, for the sake of, I referred these all over the place. Here we are. So it's on line 143. So we go to line 143. That's here. So at the top, I've got dates, and these are the Sunday night, basically the Sunday night dates, and below them I've got the forecasts. So this has been variously forecast by Owen on Sunday evening between 300, 220, 300, 270, 300, 160, 200, 226, 226. So all over the place, in other words. So I'm pretty careful with it anyway. And then it's got this high price to earnings ratio. And it is also a high price stock at basically $99. So, it's not going to figure as one of my favorites anytime soon. But for all of those reasons.
Yeah, thanks for taking us through that.
Yeah.
Okay.
So, I mean,
But none of those PE ratios seem to correlate with any of the information that's on Value Line.
It's totally different.
Yeah. I mean, if you look at any of them, you could pick anyone at random. I mean, some of them have got, you know, they're not currently making profits or positive earnings, so the PE ratio is quite meaningless. But if you pick any one of them and look at the value that you get on Value Line, it doesn't bear any relationship to that PE ratio figure that's shown there.
Well, I'm not sure how often the Value Line ones are updated. If it's only when the quarterly report comes out, that could go somewhere to it. But what we need to do is to check it with a third party, basically. So, you know, check it out on Yahoo Finance or something, or Earnings Whisper Calendar, or, you know, somewhere else to triangulate it a bit.
I think the PE ratio that you see on the Value Line site before you pull up the PDF is based on the current price, but when you pull up the report, it's based on the price that was done, the price that existed when the report was created.
Right. Well, I can use those, and I'm going through the Value Line reports anyway. The reason that I preferred to use the one that's coming from the search engine is that that's then dynamic. As the price changes in the search engine, then the price of the PE ratio should change as well. But yeah, we probably need to do a bit of work to see how reliable they are, and whether, you know, whether it's even worth having them there.
It was just if you were using them to as part of your decision-making process, then I think there's question marks as to how reliable they are, how accurate they are.
Have you got Value Line up? Can you look up Spotify and see what it is?
It doesn't come up with anything for Spotify because it's not generating positive earnings, so it's like trying to divide by zero.
All right, so
with a,
right, okay.
I've found one online on something else with it. Spotify's forward PE ratio is minus 735.4.
Right, so where it's actually Bing, isn't it? I think they come from. So where they're getting it from, who knows? So I mean, it's never at the moment going to be a favorite in any respect, and it would be very speculative. I mean, they're saying it could go up to 200, 300. I'm saying if we did it, I'd only be trusting it up to 140 anyway. So, and even then, when it came to it, I probably wouldn't. I'd go below that. But yeah, even at that, you see, if those figures were still current from Monday, then you'd be talking about 19 cents a day. So if it can be trusted to get to 140, then it is worth doing.
Yeah.
So that's then becomes your sort of risk to reward ratio. Yeah, there's a big risk because it's expensive and we're not sure of the data, but there's a big reward. Let's have a look at the chart.
Again, these are interesting discussions to have at the moment, though, aren't they? That, you know, the whole risk reward thing about what happens to individual stocks in the portfolio are good things for us all to be discussing, aren't they?
Yeah, definitely. I mean, it looks pretty much like the chart of the S&P 500, actually. But yeah,
that's eBay, isn't it?
Sorry, that's eBay. We're on Spotify, aren't we?
It'll probably be pretty similar.
Yeah, interesting to see, actually. Yeah. On spot. There it is. Yeah, because it hasn't been going that long. Yeah, I mean that started in sort of 2018, and it's below that at the moment. So if we were going into it, it was at the 140 level, which is sort of here. Sorry, are you looking at the chart?
Yes.
Yeah.
So it's about this sort of level. So we wouldn't be asking it to do a lot of work. And if you look at how many times it's been at that point previously in its short histories, 1, 2, 3, 4, 5, 6, 7, 8. So I wouldn't be going in for 1,000 of them or anything, but 100 I might.
Yeah, sure.
Yeah.
Yeah, the indicators at the bottom seem to be turning the right way, don't they?
Yeah, yeah, they do. And in terms of a risk to reward ratio, you would normally use, well, where's the lowest it's been, which is about where it is now. That's a 1, 2, 3. It's at a 3-year low, so it's very, very low.
So Spotify at the minute is using it's using its launch price and its lowest price as a line of support at the minute, isn't it?
Yes, yes.
So you'd be worried about Spotify if it broke that line of support going downwards, wouldn't you?
Yes, yeah. Yeah, it's not something we're going to rush into, whatever happens.
If it keeps bouncing off it, then it's probably worth a few quid every now and again.
Oh yeah, and it doesn't need a lot of life breathing into it to make it go. What I would probably do is say wait and see the next value line report and read that on it. And on so I actually keep that on here, line 43. Yeah, the latest report was on the 29th of April. So I'll be looking at that and sort of just, then try to track it on news sites and so on. Okay.
Thank you.
So I think we're about there. I don't think there's anything else I want to do this evening. I just keep you in touch. Keep watching the SP 500. And even that, I mean, we should recover more quickly than the SP 500 because that's got all sorts of things in it we wouldn't touch.
Sorry, a question on relating to demo accounts, Jeff.
Yeah.
Who would actually give that support, or what? Is there anyone who can do support on that?
Yeah, well, yes, yeah. As long as it's a demo, as long as it's an account that we know. So I mean, I prefer it to be with Alpha Plan, even if you then go off and open an account with somebody else. Yeah, I don't want to have to learn a new platform sort of thing. But the questions should be the same. The platforms generally do the same thing. Life's a bit simpler with the demo because, well, obviously you can't lose money, but also generally you can't negotiate. You're just dealing with the prices that you're looking at.
Right.
And if you open one, Andrew, resist putting in too much money. They start you off with $1 million or something. Put in a more realistic, you do usually get a choice. So put a more realistic amount of money in that you're likely to be actually trading with. Otherwise, you'll never sort of have to learn about what happens as your stock buying power goes down and so on.
Just to give you an example, I've actually opened an account, but what happens, it's dropped below the 25,000 minimum. And I've basically had to, over this time period, especially this volatile period, it's dropped below the 25 to maybe about 21,000.
Yeah.
And it's not allowing me to do.
Oh, and that's it. I would just close it and open another one, but put a bit more in this time. You put in 100,000 or something, so you don't run the danger of that.
Okay. I wanted to just be more realistic as to see what the situation was if I did the 25,000.
Yeah, well, you can't be wholly realistic. In that some of the techniques that we use to get out of trouble, I don't think it would allow you to use. So you don't need to go, very, very high, but if you went with 50,000 or something, that would be fine.
All right.
Yeah, even if you're only planning on putting in 10, don't worry about it. Put in 50 to get the learning experience from it.
Yes. Okay.
Yeah. But yeah, more than happy to support anybody on their trading, whether it's a live account or a demo account, no problem.